In uncertain times, it's good to diversify, as all eggs in one basket can be broken pretty quickly. This is where multi-asset investment comes into its own. Here to talk me through the fundamentals is Yoram Lustig, author of Multi-Asset Investing. Well, Yoram, how important or indeed popular is multi-asset investment today, considering the economic environment we find ourselves in?
Volatile economic environment and volatile markets make it even more in demand, because if you just invest in equities, for example, you can suffer from volatility, from negative returns, and now to diversify makes even more sense.
But it has changed quite a bit from the equity bond mix of old. In fact, people today really are expecting tailored solutions to their financial needs. Talk me through this.
Traditionally in the UK, we used to have the balanced managed fund, typical 60 equity, 40% bonds. Over 90% of the risk actually comes from equities. What happens now is that we have more modern multi-asset funds. They include a wide array of asset classes. They go into alternatives, for example. They use derivative strategies to mitigate downside risk and enhance diversification. So we moved a long way from the traditional balanced funds. Now, as for customization or tailoring a solution for you, in asset management, size does matter. So if you are a big investor like a big pension plan or a bank or an insurance company or a wealthy individual, of course you can go to your advisor or asset manager and they will customize a portfolio specifically for your needs. But if you are a smaller individual investor, you are unlikely to get the tailored service. However, another trend which started a couple of years ago was to launch financial products which are tailored to meet certain outcomes that individual investors need.
But there are so many options out there. How do you get the right asset allocation?
So your asset allocation needs to fit your investment objectives. So if you are targeting a certain return, for example, you want 5% per year, it means that you need to take a certain level of risk, let's say 10% volatility, which is only one measure of risk. Then you need to take into account your investment horizon. Are you investing for 1 year? Are you investing for 20 years? If it's only for 1 year, your asset allocation should be very conservative, cash and maybe short-term bonds. Don't touch equities. If you're investing for 20 years, equities are a good possibility. Then your liquidity needs are another factor to consider. Do you need the cash immediately? And then you need to hold only liquid assets that you can sell quickly and raise cash. Or you can bear illiquidity, and then you can buy stuff like real estate, and you can harvest the illiquidity premium or the liquidity premium. So that's the starting point for everything. Your objectives and constraints. Then, to formalize an asset allocation, the key there is to look to the future, not to the past. The returns that we had in the past are in the past, and they can teach us about how asset classes behave, but we cannot just extrapolate them into the future.
How accurate is this forecasting? Because I know a lot of people out there do really struggle when it comes to predicting the future.
Predicting the future, unfortunately, that's what our industry is all about. The good thing is that if you have the luxury of a long investment horizon, predicting asset classes over the long term is much more credible than predicting asset behavior over the short term. And that's because over the long term, what happens is that assets tend to revert back to fundamentals. So the macroeconomic environment and valuations, they determine a big chunk of your long-term returns. However, over the short term, it's mainly about sentiment.
Risk is, of course, at the center of multi-asset investing. How would you say the best way to go about balancing it in your portfolio is?
The key for good balancing of the risks is to have your portfolio fairly balanced across different risks which are independent of each other. And I'm talking about risk factors. These are the underlying risks that drive the return and risk of asset classes. So, for example, when you look at equities, the three main risk factors that drive equity performance over the long term are economic growth, commodity prices, and inflation. Corporate bonds, the main risk factors driving their performance are interest rates, inflation, and actually also economic growth, because it drives the spread between the yields of corporate bonds and underlying government bonds. So if you combine in a portfolio equities and corporate bonds, you think you are well diversified, but because equities and corporate bonds share the same risk factor, which is economic growth, you may double up on a single risk. So to make sure that you are truly diversified, you need to make sure that you are exposed to different kinds of risks which are independent of each other.